Hi guys, good evening to all of y'all. Hopefully my screen is visible and my audio is audible. I'm extremely sorry that I could not upload the remaining two questions of Greer Co. I was a bit busy for the past 2 days, but from today onwards I'll be uploading continuously of all the revisions that have been done. Right. So on that day we discussed Greer Co, which was a March-June 2023 paper, and we were able to complete, I guess, the first two questions, A and B respectively. So we are left out now with C and D, right? Since C is a 9 mark question, I would like to complete the D part and after move on to C, which would be done in the latter, right? Hopefully, if there is time, I would try to start off Sterling, but there's a 90% chance that I would not. Okay. So if that is so, give me a minute. That is so. Yeah, that is so. Let us first look into the D question, right? They are requesting us to use Exhibit 4. That means, I guess, the loan agreement part. And they want us to calculate as well as briefly outline, right? So they want us to calculate the for 6 marks as well as a brief outline. They want us to explain it briefly, right? In accordance with IFRS 9. So hopefully you all have studied IFRS 9 financial instruments. And you all know IFRS 9 examiner, he likes to test it as much as possible in any of the questions. So you all will be getting 4 questions for 100 marks, and there's a high chance, high probability that the examiner will test you all with IFRS 9, right? We cannot guarantee that it would be in the first question or the third or fourth, but anyway, anyhow, this will be tested. It's a sure shot, 100% confirmed question, right? Uh, and how the loan would be accounted during the period 1st January 2006 to 31st December 2007, right? So, first mistake that most of us make is that we would not briefly outline, right? Most of us would stop with calculations. That would be the very first mistake. Number two is the second mistake that most of us would do is all of us forget that this requirement particularly requires us to prepare accounts for 2 years, right? Normally, as per practice, most of us are only supposed to prepare the accounts for 1 year, but this time the examiner has specifically asked us to prepare accounts for 2 years in terms of IFRS 9, right? So what we need to know, we need to calculate as well as outline it, okay, related to IFRS 9 and calculate it only for 2 periods, right? If that is so, let us move on to the calculation. This is the fourth exhibit, which is a loan agreement. Fine. Loan agreement means automatically that you all should know it would belong to an IFRS 9, right? It could be a financial liability, right? A financial liability. Financial liability means it's a present obligation where you're supposed to deliver cash or any financial asset. That would be a simple definition of financial liability, right? Which is not needed at all, right? Because they want us to only briefly explain about the calculation. Okay. So Greer Co took out 27 million bank loan on 1st January 2006, right? For 5 years. After 5 years, we are supposed to repay. Let me again, as I remember, let me again go and look into the financial year end. Okay. So the financial year end is 31st December 2007, right? So this loan was taken a year before the financial year beginning, right? On 1st January 2006. Interest charged at 5% per annum, fine, no problem. And they are paid in annual, right? They are paid in arrears. That means they are paid in after the year end finishes on 31st December, we will hand over the interest payment. Okay. Transaction cost is $675,000, which were paid on 1st January 2006, right? So as most of you all who knows, you all would have done FR, right? In FR's continuation is only the financial instruments. In terms of financial liability, what you all should know is whenever there is a transaction cost in terms of initial measurement, right? Any transaction cost is supposed to be deducted from the initial amount that is taken, right? For example, in this question, we have taken 27 million, right? And we are incurring a 675,000 transaction cost. If that transaction cost was a financial asset, if it meets the criteria, right? We would either expense it off to P&L, or we could either capitalize it. That is in terms of financial asset. But in this particular question, right, they are referring to a financial liability. How do I calculate? How do I know whether it's a financial liability? We are taking a bank loan, right? So due to that, and we have a contractual payment, we have a contractual obligation to pay in 5 years. So these meets the criteria of financial liability. Therefore, right, any transaction cost needs to be removed from the initial loan amount, right? So hopefully I'll remember that. Remove from initial loan amount, right? So we have taken 27 million. So from 27 million, we will have to deduct the 675,000, right? So your initial measurement of that particular loan would be, right? Initial measurement of that particular loan would be 27,000 was the loan as at 2006, right? And you all will have to deduct 675,000, which would give you, 26,325. So this would be your initial measurement. Okay. And hopefully I'll remember that any initial measurement in terms of financial instrument, it could either be your financial asset as well as your financial liability. All those must be mentioned, all those figures must be in terms of fair value, right? Hopefully I'll remember that. All those must be in terms of fair value. So the fair value on 1st January 2006, before the current year beginning, would be 26,325. How do we arrive at it? We would take the cost or the loan amount, and from that we will have to deduct the transaction cost, right? We will have to deduct the transaction cost. Okay. Okay. So that is in terms of initial measurement, right? That is in terms of initial measurement. So you all know that after we initially recognize a financial asset or a liability, right, we will have to do subsequent measurement, right? We will have to do subsequent measurement. Okay. So let us go and do that as well. Let us go and do that as well. Okay. So since they told us to briefly outline, right, one of the outline that you all could do, or one of the point that you all could give, is the transaction cost removal, right? Simply speak about the transaction cost removal. If you all want, you all could include double entries. If you all don't want, you all can omit, no problem at all. But make sure that you all mention that the transaction cost in terms of financial liability must be removed from the initial measurement, right? So that would give you a 1 point, right? As you all could see on the left side corner, I have attached the what we call the marking scheme of the examiner. So based on that, you all could, write or calculate or outline your answers. Okay. Okay. Then later on, as I told you all, we need to calculate the subsequent measurement. So if you all have time, in hand, if you all have time, what you all could do is you all could, try to calculate this in a presentable manner. Like, see, most of us, we have a time management problem, right? When I was doing exams as well, I had a particular time management problem. So I could not draw, I could not present it in a you know in a proper manner so that examiner will be satisfied. I just calculated the calculations just for the sake of getting off marks. So try to manage time as much as possible, right? So let me do these questions with you all. Right? Okay. So subsequent measurement, right? So you all know, in terms of financial liability, you all are supposed to, if it's a financial liability, you all are supposed to use the default method, which is an amortized table method or amortized cost model, or it is amortized cost model. So that also you all could mention in your outline, right? That also you all could mention in your outline, amortized cost model, right? This also can be mentioned in your answer screen, right? Because then it makes sure that you don't only know to calculate, but you know what is behind those calculations, what is exactly happening behind those calculations as per IFRS 9, right? So as at 31st December 2006, because that was what the examiner needed, examiner wanted us to find out from the period, right? He mentions a period or a time gap. The time gap is from 1st January 2006 to 31st December 2007. So this includes 2 financial years, right? This includes 2 financial years. So for the first financial year, which would be 31st December 2006, automatically 26,325 would be the balance brought forward, right? The balance brought forward would be 26,325, right? And another point that you all could discuss in terms of answering or outlining, right? What you all could discuss is try to speak on what would be the effective rate, right? As well as coupon rate, right? Try to speak on that as well. You all know, we are restricted on news in order to find out the interest expense. See, now you all have obtained a loan, right? A loan which is repayable in another 5 years, right? Normally, if a loan is repaid in 5 years, an interest rate would be attached, right? An interest rate would be attached. That interest rate would be calculated in terms of effective rate. Hopefully, you all are aware of this. You all have to calculate that interest expense on that particular loan based on the effective rate. Okay. So let us go and find out what is the effective rate. Okay, here it is. Effective rate for the year is 5.6%, right? Effective rate is 5.6%, right? So you all know the loan that was obtained was 26,325. It had a fair value on 31st December as 26,325 before any adjustments. Now we are going to adjust. We are going to make some further adjustments, which would be interest expense, right? So 26,325 at an interest rate of 5.60% per annum, right? So you all will be getting an interest expense of 1,474.2, right? You all can round it off for one decimal place, right? And this interest expense will be needed to be included in your P&L, right? It needed to be included in your P&L, right? As an expense, for the year 2006. So in your 2006 financial statement, which will be a profit or loss, you all need to include 1,474.2 under your financial expenses, right? And your financial liability also will be needed to include a 1,474.2, right? Why? Whenever we have a loan, right, the interest expense also will increase our loan amount. The interest expense also will increase our loan amount. Why? We need to pay at the redemption date. Right? At the redemption date, what would you all be paying? What would you all be paying at the redemption date? Right? At redemption date, most of you all know we will be paying the principal amount, right? Principal amount, as well as no one is going to give a loan for free, right? None of us are generous to give a loan for free, right? So we need to prepay back an interest, right? So any interest that is being charged, at the effective rate will be added back to the liability, So therefore, if this interest charge of 1,474.2 will be incurred in the financial year of 2006, a corresponding entry should be applicable in your SOFP under financial liability. Hopefully that is clear with all, right? And we know when we are going to make a payment, right? We would make the payment which includes both the principal amount as well as the interest expense, right? How do we calculate that? Let us read on. How do we calculate that? Thank you. Can you all see here? They have given us the interest that is charged is 5% per annum. this would be our coupon rate. This would be our coupon rate. Most of you might be thinking, how did I find out this is a coupon rate? Because they have mentioned for this particularly effective rate, but this nothing was mentioned in terms of coupon rate, right? So you all might be having a doubt of how did I derive whether it's a coupon rate or not? Well, you all see, normally coupon rate is less than the market rate, is less than the effective rate, sorry. Right? So this is one of the ways of how I found that should be the ideal percentage that I'm supposed to use. Oh, obviously, guys, they have only given you all, I mean, simple common sense, right? They have only given you all two interest rates, right? One has been already used to calculate your interest expense. So obviously, the remaining rate that would be is supposed to be used to calculate your cash payments. That's all that you all need to know, right? And all these basics have been provided for you all in terms of your financial reporting in your skills level. Okay. So moving on. Now, how do we find out this cash payments? Right? The cash payment would be simply the initial loan that has been taken before the deduction of transaction cost, right? Which is 27,000 into 5%, into 5%, which is 1,350, which is 1,350, right? And this, guys, it would not change at all. Okay, it would not be changing at all. It would be constantly the same amount will be carried forward for every financial year until you all pay that particular loan, right? Until you all repay that loan with the capital as well as the interest, this 1,350 will be remaining the same, right? For example, if they wanted to calculate for 31st December 2008, right? Simply copy paste this. You all will be just getting a free mark, right? You all will be just getting a free mark. Okay, so I'll be getting a free mark. So that's also there. Okay. Okay, so we are done now, done with the 31st December 2006. 31st December 2006. Okay, now they want us to outline, right? So they want us to outline what are the particular information that we could give for the examiner, we know, right? We have already given this in terms of initial measurements. There is no point of again rewriting it. We can speak about the interest expense, right? About the financial expense that will be hitting our P&L. So because of the P&L, our profits are going to reduce. We can speak about that, as well as if you want, you can speak about the SOFP component. You can speak about the SOFP component where the financial liability will increase because of the interest expense that is being charged on your principal amount, right? And after that, obviously we need to pay here. See, obviously you can speak about this also. You can copy paste this, right? You all need to pay interest as well as the principal amount annually on 31st December. So you all can say that this on 31st December 2006, on 31st December 2006, our company is entitled or we have a present obligation to deliver 1,350 as our interest repayment, right? As our loan or as our loan repayment, which includes the interest, right? And finally, you all can mention as at 31st December 2006 at the reporting date, which would be 31st December 2006, right? Or the closing year end. You all need to deduct, you all need to include 26,449.2 as your financial liability, right? As your financial liability. You all started off the year with 26,325. You all had an increase in liability of 1.474. You all had a reduction of payments of 1,350, right? So the remaining, this would be going to your financial liability. So what you need to know is this is your P&L component, right? This person would affect my P&L. This person is going to affect my cash flows because I am obviously I'm paying loan repayments, right? So it will be recorded under cash flows, IAS 9 under financing activities as an outflow, right? This person would be recorded as your balance sheet. So this is all you need to know. Make sure that you all mention this particular parts or sections in your answer, right? So after you mention that, now an interesting part occurs, right? For most of you all who have read this, I told you all in the previous class, Make sure that you all read this question and come, because this is a way more interesting question. And for the very first time, they have tested this part in particular. Okay. So let me read on. Okay. Let me read on. On 31st December 2007, right? Now what is happening? Let me change the color of the pen. Let me change the color of the pen as well. On 31st December 2007, something interesting is going to happen, right? Something interesting is going to happen. Greer Co, right, has negotiated a change to the terms of its loan, right, at no cost. What does this mean? What does this mean? Okay, so Greer Co would have had any financial difficulties, or Greer Co would have a proper relationship with the bank, or what I would say is, Greer Co was having a proper bargaining power, right? Using all these factors, Greer Co has gone and negotiated to the person who gave the loan, saying, "Here, see, hi, right? Unfortunately, at this moment, I'm not able to repay your loans, right? I'm only able to pay your capital amounts." Or he would have, argued in a way saying that, he would have had a favorable argument in terms of, which is favor in terms of Greer Co. And he told that he has got an exemption. He has got an exemption where he does not need to pay his interest, right? No interest repayment, right? So for most of y'all, obviously, this is a cost saving, right? I mean, as long as I get a interest, I mean, as long as I get a waiver for my interest, it's a cost saving, right, for us. Because why would I go and, I mean, why would I need to go and pay my interest expense when I could get it for free? So he has negotiated. The negotiation was successful, right? The other party, the third party, agreed for that. Fine, you all don't need to pay us the interest cost, so no problem. You all only repay us the principal amount, the loan which you all took. That is more than enough, right? They told that to Greer Co. So let me again read on. This has resulted in the waiver of fine of the interest payment due on that date, with all the contractual cash flows remaining payable. Right? So this is what I told. This is what I told. This is simply in written form. Right? You all know the contractual payment or contractual cash flows is the principal amount. Right? Obviously, the third party is not mad. Obviously, they are not mad to give you all a waiver of loan plus the principal amount. No, then it's not a win-win situation, right? So you all need to pay a principal amount, but the entire interest cost is scrapped off. You all don't need to pay that at all, right? So, what do you call this kind of situation? What do you call this kind of situation? Well, this situation is called a modification. This situation is called a modification in contract, right? A modification in contract. See, a modification can happen in multiple ways, right? Let me take this to my Excel. So y'all would, sorry, let me take this to my Excel so y'all would have a clear understanding. Yeah, understanding. Where would I include this? Where is this relevant for me to include, first of all? So these are your notes. These are your additional notes, right? These are your additional notes. Control B, Control U. Okay, let me include it here. Hopefully it's fine, right? So this would be one. This will let me keep A and B respectively. This would be a second note and third note. Contract modifications, right? So contract modification can take numerous forms, right? In terms of if you all change your interest rates, right? If you all change your interest rates, for example, this is 5.60, right? You all can change it for 6% as well as you all can change it for 4% if there is a change in interest rate, okay? Or, or if there is any change in this coupon rate, right? All of this will be deemed, all of this will be deemed or will be known as your contract modification. This is a particular part that has been introduced in your SBR syllabus. So make sure you all have a read through this, right? Make sure you all have a read through this. Okay. Reading on the modification of the financial terms, right? The modification to the financial terms of the original bank loan is not considered to be substantive. So, what do they say? What do they say? They got this waiver, right? Of no interest prepayments. Well, after including that into their calculation, they were able to see that the impact on the loan, right, at 31st December 2007, because that was the year where they negotiated, right? So because of that, the impact was not substantive. Substantive means the impact was not material, or the impact was minute. It was a minimal amount, 0 or 2%, 1% of that sort. So obviously, if that has affected 1 or 2%, right, you all don't need to change. Don't worry, I'll explain this when I come to the Excel sheet. I'll explain this. This is a separate point. This is a separate part that I need to explain, right? So if you all have the basic understanding, you all be able to understand for the people who have gone through IFRS 9 in terms of SBR. But I will tell you all, for now, keep it as you all had a no interest repayment, right? Because of that, there will be an impact in your closing balance of the loan, right? And that impact was not major, it is a minor impact, right? Simply consider it as a minor impact, okay? For now, right? Minor impact, okay, fine. The present value of the modified, the present value of who? The present value of the modified contractual cash flows at the original effective rate is 26,841. Okay, let me see what do I need to do with these two particular things that has been marked in green, right? This is number one. They told that it was not substantive, fine, okay. And they have given us something called the present value. Why would they give? Let us go and look into the question, right? Let us go and look into the question. Okay, okay, right. Yes, there was something. Balance brought forward plus the interest expense minus the cash payment. One minute. There is a small issue in my There's a small issue in my Excel sheet. Let me reload it. Okay. Found it. There's a comma right here after my percentage, so that's what it has not been working. So it should be ideally this into this, right? So my balance carried down would be opening balance plus the interest expense minus the financial repayment, loan repayment, right? So copy this and paste this, right? Obviously, I'll know the closing balance at the year end of 2006 will be my opening balance, right? Would be my opening balance. So I would just simply copy paste it. I would just simply copy paste this. This has a particular format, so I'm copy pasting the same format. So 26,449 into 5.60. 26,449 into 5.60, which is the effective rate, would give me the interest expense at the year uh 2007. This would be my interest expense, right? 1.481. So the same format, the same explanation, right? You will be going and including saying that at the date of 2007, right? In the PNL, you will be including 1481, right? Make sure that you all show this as two separate line items so that examiner understands that you have understood the question of segregating two financial years, which is 2006 as well as 2007. Make sure that you all separately identify that and separately show it, right? Okay, now comes the best part. Now comes the best part, right? Most of us, for the people who don't know modification, what we would do is, we would just simply, go on to, we would not simply adjust anything, right? We would have forgot modification, or we would not know the concept of modification. So we would just, take the exact same cash payment, copy it down, because I told all always the cash payments would remain constant unless there is a modification. Cash payments would remain constant unless there is a modification, right? Cash payment remain constant unless there is a modification, right? Unless there is a modification. Okay. Unless there is a modification. Okay. So, uh, speak about the interest expense, carrying value at the reporting date and the coupon rate being the same. Right? And make sure that you break it also and show, as I told you all, those are two separate years, right? The examiner wants us to speak about two separate years, so make sure that you break and show separate. Okay. Right, so speak about two interest expenses rather than putting off both of them in one, right? Because both depicts two separate financial years. Okay. Okay, so this particular method is wrong, right? Because this particular method is wrong. Why I would say is wrong? Can you see here that we went and negotiated, right? What did we negotiate is that this has resulted in the waiver of the interest payment, right? Interest payment due on that date, right? So I told you, all right, we need to make a cash payment. That cash payment can be called as interest payment as well, right? Now, don't get confused, right? Most of us will get confused. Initially, when I studied also, I thought, okay, what does the examiner mean by interest payment? I went and thought interest payment would be this interest expense. No, interest payment is cash payment, right? For your easiness, I'm writing it here, interest payment, right? Never get misleaded or misguided, right? Always, if there's a interest payment, or if you'll find any term that is being written as interest, or if you'll find any term that is being referred as payment, obviously any payments that is being made is a cash outflow, right? It is this part, it is this particular part, right? Don't go and mislead or misguide yourselves, or don't go and do a wrong classification to consider the interest expense, right? If there is a, let me again repeat it, if there is a interest payment, what they mean is your cash outflow, right? This column. Okay, so make sure you all remember that. That's also an additional point, right? See, I'm giving all the points that is relevant. Whatever you all want, take it. Whatever you don't want, disregard it. Simple as that, right? Interest payment is equals to your cash repayment, or yeah, keep it as simple, cash repayment, right? This is all you only need to know. Okay, so now at this point, guys, at this point, what happens is a modification takes place. A modification takes place, right? A modification takes place, right? A modification takes place. Okay. Okay. Sorry. A modification takes place at this point. Okay. So yeah, it is. Let me keep it here. Modification, right? The modification takes place at this part. So because the modification starts at the examiner specifically mentions that it starts on 31st December 2007. So what he told is that we don't need to pay our interest repayments because we have got a waiver. If you all read this, you all be able to understand. You all can pause the video and you all can read this again. All right. So you all don't need to pay a payment. So ideally this was supposed to be 1,350, but since you all got the waiver of, you all will need to be including a zero, right? Since there is no repayment, you all don't need to pay any repayment, right? You all don't need to pay any repayment. This 5% is not applicable. Okay, simply considered as that. So after the repayment, right? After the repayment at the 31st December 2007, right? At the 31st December 2007, your balance carried down or whatever the balance that you all need to record in terms of financial liability in your SOFP for the year end, the 2007, is 27,930 after adding your interest expense and after deducting zero cash payments, right? Because of the modification. This also needs to be included. This also needs to be included, right? If you include this, you will be getting 1 mark, 2 marks, say about 3 for explanation. You will be getting 3 marks, right? You'll be getting 3 marks for your explanation. So far, we are done. So far, almost we are done, right? So what is the new learning? What is the new learning? The new learning would be if there is a contract modification, make sure you identify where the contract modification. In this particular scenario, the contract modification occurs in your cash repayments where they told that you don't need to repay any single amount. Not even a single penny is to be repaid back, right? Okay. Okay. So this is what I've mentioned. This is what I've outlined, right? For the year 2006, you all need to speak about your interest expense and you all need to show your SOFP. And in year 2007, you all need to mention about your interest expense of 1481. Here it is, 1481, right? And you all need to speak about your financial liability, right? Financial liability. Okay. Right. Okay. Now, there is another part that you all need to include into your answer, right? This contractual modification will give you all two effects. Again, listen to me. This contractual modifications will give you all two effects. One of the effect was in your amortization table where you all charge zero cash payments, right? That was one of the impacts, right? There is another impact that most of you all might be forgetting, right? What that impact is. Here it is. Impact number 2. Let me mention that as well. Impact 2. Okay. Impact 2. Impact 2. Okay. What would I say is that impact 2? Here, see, I told you there are two parts that I need to discuss in terms of contract modification, right? One part was already discussed. This person affected my amortization table. So I went and included that in my amortization table. So that's almost done, right? The present value, right? The present value of the modified contractual cash flows. Again, I would repeat the present value of the modified contractual cash flows, right, is 26,841. Okay. Ideally, what is supposed to be done was we modified our contract, right? Because of our modification, what happened was the present value was recalculated. Ideally, when you're doing a contract modification, you all need to remodify or recalculate your carrying value, right? because obviously you all need to remove off or you all need to make the adjustments in terms of a cash payments. So the examiner has done that, right? Normally, always after you do your modification, a present value will be automatically calculated and given by the examiner. You all don't need to calculate this, right? You all don't need to calculate this at all. Examiner will calculate this and give to you all. Okay. So after the modification, examiner has calculated and given 26,841,000, right? That is the present value. That is the present value which is supposed to be after the modification, right? After the modification. This is the present value that is ideally supposed to be recorded in your financial year end for the year 2007. But what happened? But what happened after the zero repayment? After the zero repayment, after the zero repayment, actually, our 31st December 2007, the actual figure after the zero repayment is 27,930. See, so I have brought that calculation as well here. I brought that as well. It was supposed to be 26,841, right? Your actual is only 27,930. Can you all see? Can you all see? You all are actually supposed to pay 27,930 as per your amortization table. As per your amortization table, you all are supposed to repay. You all are supposed to repay 27,930, right? You all are supposed to repay 27,930, right? You all need to repay 27,930 back. This is the amount that you all are actually supposed to repay. But due to the contract modification, right, you have got a gain. You only need to pay 26,841. You only need to pay 26,841. You all only need to pay 26,841. Because again, I'm repeating myself, as per our calculations in terms of amortization table, we were supposed to pay 27,930, right? We were supposed to pay 27,930, but because of the contract modification, right? Because of the contract modification, the examiner has given us that now, as at 31st December 2007, our present value is only 26,841. So we get a gain, right? We were supposed to pay 27,930, but we will only be paying 26,841. So the difference in between these two, is known as a gain, right? All this you all mentioned, right? You all will have your marks guaranteed. This is sure shot. You all need to mention, right? Mention the initial measurement, mention the subsequent measurement, mention the zero, right? Mention where these people are going to get affected in either PNL or SOFP or cash flows, anything, right? Mention as well as the impact number 2, whether it's a gain or loss, right? This would get your all the calculation marks that is required. So if they have allocated about 3 marks for calculation, you have to get the entire 3 marks that is needed, right? Now, in terms of explanation, right? In terms of explanation, let me use the examiner's explanation itself. Let me use the examiner's explanation itself, right? Let me use the examiner's explanation itself. Okay. Let me use the examiner's explanation itself. So that, we don't waste time. Already we are 9:56 at 9:56. Okay. We have another one last final question to do. I would, for that question, I would read through the examiner's this one. I have prepared some notes, but I will share that. But I will read that and read through some. Okay. When I come there, I'll let you know. Okay. So what you all need to explain, right? This is all about explanation only because we have done all the calculations. I have showed you all the calculations for 3 marks. This is your explanation part. Explanation. How do you all get the additional 3 marks? How do you all get the additional 3 marks? What you all need to mention is, right, the loan has to be recognized at 26,325. Why? After lessing off or after reducing off your transaction cost. This is your 1 mark. This is your 1 mark. Right? This is your 1 mark. Okay? This would be a 1 mark. After it, here the second mark is speak about simply 2006 before the any contract modifications. What you all need to speak? You all need to speak about the interest expense, and you all need to speak about the carrying value. Here, see, I have mentioned it. Here, see, I have mentioned it. You all need to speak about the interest expense, right? As well as you all need to speak about your carrying value as at 2006. What is the carrying value you are going to record in terms of financial liability, right? If you all record that, you all will get 2 mark, right? So what is lucky? Another one more mark more. Another one more mark more, right? Another one more mark is needed for you all to finish it off. Okay, right? Another one more mark. Here it is. The gain which we calculated again, right? We calculated again, right? So that gain, right? That gain, right, is needed to be recorded in your P&L. That gain is needed to be recorded in your P&L. This would give you a 3 mark, right? This would be giving you a 3 mark. This would be giving you a 3 mark. This would be giving you a 3 mark. Okay. Another one point that I would like to indicate, another one point that I would like to show you all, right? This is a final point that you all need to know, right? In terms of that, I told you all there is a word called substantive, right? Substantive, here it is, okay. Substantive synonyms, right? So substantive synonyms could be, okay, leave that. I told you all there is a substantive part, right? How do you all determine this, whether it's a substantive or not? How do you all determine whether it's material or not? How do you all determine whether it's impactful or not? How do you all determine? How do you all determine? Okay, I will tell you all that, right? That is your last, this one. I will tell you all that as well. Look at this, okay? Look at this. Look at this. Right, sorry. Right. Final point. How to determine whether substantial or not. Right. This is a question that might be arising in most of y'all. How do I determine? How do I determine? The reason why I'm stressing on this point is there is an impact. There is an impact, or there is a presentational impact, I would say, in terms of your SOFP. Right. So what is the impact would be, guys? You all found out this gain, right? This gain, right? This gain over the original carrying value into 100%, right? How much was my gain? It was 1089 divided by my actual carrying value was 27,930. In terms of percentage, it is giving me, in terms of percentage, it is giving me a 3.90%, right? So what does the IFRS 9 rule say in terms of modification? IFRS 9 rule for contract modification. What does it state? It states that if the change, right? This is the change, guys. This is the change. Let me mark it in blue for y'all. Let me mark it in blue, right? If the change, right? If the change, like I'll indicate that also, which is a blue. If the change is less than 10%, right? If it's less than 10%, if it's less than 10%, right? This is substantive. This is substantive. This is all you all need to know. This is all you all need to know, right? If you all indicate this point, obviously examiner knows that you all have done the entire contract modification that is needed. Even examiner has forgotten to include that particular part in this, in his answer scheme. He has forgotten to put. But if you all mention this as well, y'all are outsmart. Y'all have 100% applied. It's not all about, studying, memorizing, forgetting. No, you all studied for a sake, right? Make sure that you all imply that as well, right? So always, if that change because of the contract modification, if there is a gain or loss, and that gain or loss makes an impact, right? And if that change is less than 10%, right, that is considered as substantive. So if it's considered as substantive, right, if it is substantive, simply carry forward the amortization table using the using the using this value, right? You all don't need to go and rechange it. You all don't need to go and rechange it, right? So what I would mean is, at the 1st January 2008, at 1st January 2008, if it's substantive, right? If it's not substantive, right? If it's not substantive, sorry. If it's not substantive, sorry. This is right. If it's not substantive, what you all need to do is you all can just continue with this existing calculation, right? How do you all continue? This balance will be brought forward, right, on 1st Jan 2008, right? This balance will be brought forward if this is not substantive, if the change is less than 10%, if the impact is less than 10%, right? If the change is less than 10%, right? You all can continue your calculations of amortization table using the December's balance, right? If it's less than 10%, okay? But suppose, right? But suppose if it was more than 10%, say you all found the change, or you all found the impact, you all found the impact, right? You all found the impact. You all found the impact. The impact now, for example, let me say impact was about 100,000. Okay. Impact was about how much? Say 10,000 divided by how much? If your impact was more than 10%, now see, this is hypothetical, right? This is hypothetical. This is estimate, right? If my impact was anything more than beyond 10%, if my impact was beyond 10%, guys, what I need to do is, if my impact was beyond 10%, right? I need to remeasure. I need to remeasure at what? On 1st January 2008. I need to remeasure it not at 27,930. Not the year-end balance of 2007 will be carry forward. No, I need to remeasure it at my present value, which is 26,841. Right? If it's 26,841, will be needed to be remeasured if it is substantive, if it's more than 10%. If the change was more than 10%, I need to remeasure it at 26,841, right? This is all you all need to know in terms of IFRS 9 contract modification, right? All you all need to speak, right? I'm pretty much sure you all will be able to handle until contract modification, right? Before the contract modification, until the amortization table, you all be able to handle, right? The best new part, the new learning would be the no cash repayment. Impact number 1 was here in your amortization table. Impact number 2 is your gain or loss to your P&L, right? And if you all are smart, right? If you all are smart, if you all have gone through this one, if you all want, right? If you all want, you all could speak about the impact, right? IFRS 9 rule, IFRS 9 rule, IFRS 9 rule states that, what does it state? What does it state? If the change or if the impact is less than 10%, this is not substantive. So if it's not substantive, you all can carry out your amortization table normally, right? Normally. But if it's more than 10%, if it's more than 10%, let me mention that as well. So I don't want you all to have confusions. If it is more than 10%, right? What do you all need to do if it's more than 10%, right? Remeasure, remeasure at the present value given in the calculation for the year beginning of 1st Jan 2008. This is all you all need to know, right? As a 1st Jan 2008, right? All this is all you all need to know. This is all you all need to know, right? This is all you need to know, right? Because of the contract modification, my amortization table, there was an impact, as well as for my P&L, there will be a gain or loss. The gain or loss can be calculated simply by taking the difference between the present value as well as my amortization carrying amount, right? You all know how to calculate that. I taught you all how to calculate the impact or the change, because whether to identify whether it's substantial or not. If you all do this, if you all mention all this, if you all outline this key points and calculate, you all be able to grab the entire 6 marks, right? What do they mean by outline is only you all need to integrate the important essential points, right? Don't need to go and mention all those points you all know about IFRS 9. No, only the important points are mentioned. You all be able to grab that entire 6 marks. Okay, so we are done with that question. We are done with that question, and we are moving on to our final question. We are moving on to our final question. I have written down all the I have written down all the points that is needed, right? That is needed. I have written down all the points that is needed. But since there is a time constraint and most of you all would not like for my video to be dragging a lot, what I would do is I would what I would do is I would use the examiner's answers to do explanations, right? So then I would save a lot of time. Okay. So they want me to use exhibit 3. What do they want me to use exhibit 3 and do? They want me to explain, right? And with calculations. This time they want us to explain, right? They don't want us to briefly outline. Brief means summarize. Explain means they want us to explain a lot. Not a lot. I would say explain in detailed manner. Explain in detailed manner. It's not a lot. It's not less, right? In a detailed manner. In a sufficient and detailed manner, I need to explain, right? I need to include calculations as well. Okay. How Greer Group would account for the investment in Geico. Okay. So Greer has gone and invested in Geico. Okay. Invested in Geico. In my consolidated statement of financial statement reports for the year end 31st December. Okay, fine. They want me to explain as well as they want me to calculate. Right? They want me to explain as well as calculate. Okay. Look into this. Look into your examiner's marking scheme, right? Examiner marking scheme says that he would give us a 9 mark and this is the allocation of your marks. Okay. Now, what you all need to know, here it is. See, all of this, when you all look, before doing the questions, there might be, big, large chunk of paragraphs, right? You all might be, for most of the people who might be starting past papers for the very first time, you all might be thinking, oh my God, how am I going to handle this? How am I going to get this, all this, grab this 30 marks? How am I going to write? What am I going to write? You all might be having multiple lessons. But believe me or not, this is way much easier if you all do 1 or 2 past papers. Simply all start doing 1 or 2 past papers, you all be getting the hang of it, right? And sometimes it might be interesting also. Some might be bouncers, some might be full toss, some might be spinners, some might be legs. So regardless of that, you all might be, able to tackle this question. Okay, so he wanted us to discuss with calculations of how do I account this Geico's investment. Okay, so he has gone and invested a 10%, right? 10% in what does 10% say? If you all are investing anything less than 10%, it is considered as simple investment. Simple investment, right? Normally, if you all go and do a simple investment, that is to be shown in non-current asset. that is to be shown in non-current asset as a separate line. That is to be shown in your non-current asset as a separate line. Anything less than 10%, anything less than 20%, anything less than 20%, you all be going and showing it under your non-current asset as a simple investment, right? Normally, you all invest to get a return or a gain, right? Normally, we invest to get a return or a gain, right? Okay, here it is, right? Here it is. The gain Greer Co received, here it is. Greer Co received a dividend of 0.2 million, right? A dividend of 0.2 million. So what you all need to show is this dividend of 0.2 million is a dividend that has arisen because of your financial asset. You all went and invested, right? You all went and invested a 10% for 23 million. So because of that, you all got a 0.2 million. So what is this? What is this? Right? What is this? This is your investment income. This is your investment income. Okay. These are investment income. Investment income. Show it in your P&L under other income. Show it in your P&L under other income. Other income. Right. Go and show it under your other income. Right. For your 10%. For 10% invest. Right. Okay. If you all mention this, you all get 1 mark. If I mention this, you all are going to get 1 mark. Simply tell them where you all need to go and show this investment income of dividends. Right? Dividends is a method of income. You all need to go and tell them where you are going to show this. Okay. 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 So since you all know this 10% is a simple investment, it's a financial asset, right? It's a financial asset. If it's a financial asset, we have three ways of determining, right? We have FVOCI, we have FTPL, uh, we have the amortization method as well. Okay, we have three methods. We have three methods. Okay, okay, we have three methods. Okay, let me read on. Let me read on. Okay, he has gone and invested on 1st January for 23 million. Okay, 23 million. He has gone and invested. Fine. Okay. Greer Co elected at the initial recognition. Greer Co has elected at the initial recognition to measure it at fair value through OCI. Fair value through OCI. Why did he go and initially have an election? Why did he go and initially have an election? Since this was not held for trading. Okay. So here comes point number two. Here comes point number two. What you all can discuss in this is you all can speak about the initial recognition. Okay, you all can speak about the initial recognition. What you all can speak about the initial recognition? Here it is. What you all can speak about the initial recognition is, now see, this is a financial asset, right? This is a simple investment. This is a financial asset, right? It's going to give you all contractual cash flows in terms of dividends. Okay. So, and the Greer Co's management has elected to measure them at fair value through other components or fair value through OCI, fair value through other comprehensive income. Okay. So you all can speak about if I need to record in terms of fair value through other comprehensive income, there are two conditions that I need to meet. There are two conditions that I need to meet. Okay. What are the two conditions? What are the two conditions? Two conditions are, right? I need to have a irrevocable election, right? Irrevocable election means that once I make that particular election, right? Once I am voting, that voting will not be changed forever unless there is a modification in a contract. Unless there is a modification in a contract. For example, say I have elected that I am planning on using fair value through other comprehensive income on 1st January 2007. Say for another 10 years, for another 15 years, for another, substantial amount of years, I am not going to use, I'm not going to have, I'm not going to change this measurement method. I'm not going to change this measurement method. It's going to remain constant for any number of years. Right? This is all you need to know. You all have to speak. Number two, if not held for trading. if not held for trading. You all speak this, your 2 mark is guaranteed here. Your 2 mark is guaranteed here. Okay. So if you all don't believe me, I can show you all the examiner's marking scheme as well. Okay. Here it is, guys. Here it is. I mean, I'm just going to read it off because I'm going to read it off because on 1018, right? This is an equity investment. Obviously, I told you it's a financial asset. Since you're buying shares, in a company, in a listed company, right? Shares is an equity instrument, right? And it's not held for trading. And irrevocable election at initial recognition to measure its fair value through OCI, right? Any changes in the fair value are recognized in OCI, right? Any return are supposed to be measured in investment in OCI, right? And never be reclassified to PNL, right? So what do they mention? What do they mention? What are the key points that are needed to get your 1 mark, right? You all need to speak about your equity instrument, right? Speak about your equity instrument. It's an equity instrument. Speak about the treatment. You all need to, the two conditions you all need to speak. Speak about your two conditions, right? And after that, any changes, right? If there's any changes in fair value, you all need to speak in, you all need to speak in, you all need to go and record in FVOCI, right? Since we have elected for fair value through OCI measurement, we have to go and measure, I mean, any change, any fair value adjustment, simply any fair value adjustment is supposed to be recognized in FVOCI and never reclassified to PNL, right? This part, this part is IAS1. This part is IAS1, right? This part is IAS1. What do they say by IAS1? All right. Normally, any unrealized items only we record in OCI. Any realized items we record in PNL. All right. This you all can find in your Kaplan study text. First chapter, I guess, under conceptual framework, IAS1 is there. Study that, you'll be able to find out. Right. There's something called reclassification and non-reclassification. All right. So a best example for reclassification, I mean non-reclassification is any equity adjustment, okay? Any equity instrument, right? Any equity instrument will not be reclassified, okay? Any equity instrument will not be reclassified, okay? That's all you need to know, okay? That's all you need to know, right? So if I mention this, you'll be getting 1 mark, right? You'll be getting 1 mark. You all need to speak about IFRS 9, how the two conditions that needs to meet. After you speak about the two conditions, where will you all go and record it? Whether it's FVOCI, FVPNL. Since this is FVOCI, you all need to go and record it under other comprehensive income. What will you all record? Any gains, any gain or loss, right? Any gain or loss in terms of fair value. Any gains or loss in terms of fair value, you all need to go and record it under FVOCI, right? And you all, if you all want, you all can speak about the reclassification, right? According to IAS1, IAS1 says what? If you all need to, they have given us some indications, right? Normally in comprehensive income, again, I'm repeating myself. Normally in other comprehensive income, if there is any unrealized profits, any unrealized items, we will normally go and record it under OCI, right? But there are chances we can reclassify to PNL when it's realized. Once it become realized, we will go and reclassify it to PNL. But any equity instruments, okay, any equity instrument will not be reclassified as per IFRS 9. Okay, this is one. If I want, I can give another example as well. What I would give. Okay, revaluation gain or loss, right? You all know, right? Revaluation gain or loss. Any revaluation gain or loss in terms of IAS 16, PPE, right? These also cannot be reclassified. Cannot be reclassified. right? This is one, this is one, this is two, right? This is three. Y'all, if y'all have studied IAS 19, if y'all have studied IAS 19, right? In terms of IAS 19, y'all have a remeasurement component that is being transferred to remeasurement component that is being transferred to where it's also being transferred to OCI. That also cannot be reclassified. No reclassification, right? Right. Y'all go and read the article. Y'all go and read the article in terms of IS1. You all will know about this. Okay. So all you need to know is only about the equity instrument. There is no reclassification that you all need to know in terms of IFRS 9. Okay. So that's one mark there. Okay. Let us go and grab on our second mark. Second mark says is where do I need to go and include the dividend income? Right. Dividend income are the contractual rights to receive payment. Right. Right. Dividends are recognized in P&L, right? They are recognized in P&L. Okay. Another additional point that the examiner is giving, see, if my contractual inflows, right, contractual cash inflows are supposed to be recognized, they need to be reliable, right? They need to be measured reliable. Measured reliable means I need to identify how much I'm going to get. In this one, I'm pretty much sure I'm going to get 0.2 million. So since it's an absolute figure, since it's in physical numbers or absolute figure, there is a reliable measurement, right? And I need to have a probable. I need to have a probable economic benefits, right? So if you all mention that, you will be getting your second point. So what you all need to mention to get your second mark is where will you all go and record the investment income, right? You all be going and recording it on the P&L, right? And you all need to speak about there are two conditions, it seems. There are two conditions. The investment income, right? That particular income, dividend income, the income must be reliable measurement. You all should be able to reliably measure it. You all should be able to reliably measure it. Reliable measurement means you all should have an absolute figure. Here, see, there's an absolute figure of 0.2 million. There's an absolute figure of 0.2 million. Okay. And you all need to have a probable economic benefit, right? You all need to have a probable economic benefit. If you all speak this, you all be getting your second mark. Okay. You all be getting your second mark. Okay. You all will be getting your second mark. Okay. Don't worry, I have mentioned all those in a short and sweet manner so that you all can, have this as pointers during exams. Okay. I mentioned that. I mentioned about the dividend. Okay. 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 Where were we? Okay. We were here, right? We finished until here. Okay. So from on 1st January 2007, your initial value was 23 million, right? Okay. Okay. Here it is. Here it is. The point that I was searching for. Here it is. The fair value of 10% interest. Right? The fair value of 10% interest plus 26 million. So can you all see here from 23 million, guys, from 23 million, you all have gone to 26 million. The 10% was initially on 1st January, it was 23 million. But on 1st July, it has gone to 26 million. So there is an upward fair value. Your fair value has got a gain, right? This 26 million gain needs to be recorded in FVOCI, right? This 23 million gain needs to be recorded. So the 3 million will be needed, that 3 million will be needed to be recorded in your other comprehensive income, right? Let us go and see whether the examiners have mentioned that particular point. Yeah, here it is. On 1st July, a gain of 3 million will be recorded in OCI when the shareholding is increased to 22%, right? That we have gone and mentioned, right? We have gone and mentioned, right? I have simply put it as a pointer. If you all want, you all can elaborate as much as possible that you all need. Okay. Okay. So this is in terms of the 10% investment. 10% investment. Okay. This is in terms of 10% investment. So this is in terms of 10% investment. Reading on, guys. After that, let me change this color because I don't like green color. It's looking ugly. It's looking weird on my son. Okay, on 1st July 2007. Now, 1st July 2007 is your mid-year acquisition, right? Mid-year acquisition. What you're doing? You're acquiring further an additional 20%. That means y'all are doing another step up. Y'all are doing step up acquisition. What does step up acquisition means? Step up acquisition means that y'all are not buying the entire stake. Y'all are not buying the entire ownership in a particular company at once. Y'all are breaking it and y'all are buying one by one, one by one, one by one. You know, chunk by chunk, chunk by chunk, y'all are planning on buying. Initially, you bought 10%. After it, y'all are buying 12%. So now, on 1st July 2007, on 1st July 2007, right, y'all will be having 22% ownership. Y'all will be having 22% ownership, right? When y'all are having 22% ownership, you all know if you all need to treat under associate, you all need to have anything more than 20% is called as investment in associate, IAS 28. IAS 28. When you all are using IAS 28, guys, you all need to use equity accounting. You all need to use equity accounting, right? And also, I told you all, I hope I remember, there was this particular session I have mentioned, right? I have drawn also and shown. Whenever you all have step up acquisition, whenever you all have step up acquisition, right? You all need to consider them as small car, big car. Small car is in this 10% is your small car, and after it, you all are upgrading to 12%, right? So you all need to sell off the 10%, and after it, you all need to account it as buying. So when you all are selling off your 10%, and when you all are going to record 22%, right? You all will have a gain or loss. That gain or loss needs to be taken to P&L, right? I have mentioned that as well in one of my recordings. Please make sure I'll go and rewatch it. Okay, make sure I'll go and rewatch it. Okay, so this would give me a 3 mark. This is going to give me a 3 mark. So it's going to give me a 3 mark. Okay. Okay. Here it is. What I told through wordings, it's mentioned in in a written format. The additional investment creates an associate. I told you all. Now you all are 22%, 10 plus 12, I guess, right? 10 plus 12 is equals to 22%. Anything more than this is considered as associate, right? If you all are using associate, you all need to use equity accounting. Okay, you all need to use equity accounting, right? You all need to use equity accounting. Okay, and if you all need to get the 4th mark, I would say that try to include this as well. Try to include these points as well, right? Include step up, right? Include step up accounting, gain or loss, gain or loss. How do you all determine gain or loss? How do you all determine gain or loss? How do you all determine gain or loss? Use the big car, sorry, use the small car, big car example. Small car, big car example. Why? Why would I say small car, big car? See, y'all were initially 10%. Y'all were initially 10%. So in terms of consolidation, what you all need to do is you all need to sell off that 10%. You all need to just simply pretend, or you all need to simply consider you all are selling off the small car at 10%, and after repurchasing them as a big car. You all are repurchasing them as a big car at 22%, right? So when you all do that, a gain or a loss will arise, right? That gain or loss needs to be recorded in P&L. If you all mention this, right? 4 marks is guaranteed. 4 marks is fully guaranteed, right? You all don't need to exactly write like the examiner, right? None of us are examiners, because the reason is examiner is not writing under exam conditions, right? Again, I'm repeating, the examiners are going to write under exam conditions. We are the people who are writing under the exam conditions, not we. Now, I guess it might be y'all, right? You all are the people who are going to write under exam conditions. So he understands it. He understands it. That's what he has given you all much great marks. So utilize them. Utilize them as much as possible. But make sure that you all don't write these short and sweet answers. This is equity accounting. This is associate relationship. And don't expect examiner to give you all 2 marks for that. No, examiner wants you all to be detailed, right? Because you all are not normal financial reporting students. You all are strategical business reporting CFOs. You all are going to be one day CFOs of a company, finance controllers of a company, financial analysis of a company. Yeah, right. You all might be in different board levels. So you all need to, present it in a proper manner. If he wants a brief explanation, give you a brief explanation, right? Okay. Now I'm moving on to my calculations. Here, see, all these pointers I have given it in a simple debriefed manner. You all just need to go just read the examiner's answer, and during the 1 week or 2 weeks before the exams, just go through my pointers. Hopefully that the points will flash. Hopefully those points flash into your head, right? Okay. Now I need to do a calculation, right? What is a calculation? He wanted me to go on record. He wanted me to go on record. Here it is. He wanted me to go on record. How will I go and show this in my consolidated financial statements? He wanted me to go on record and show how will I go and show it in terms of my financial statements. Okay, let me only do that calculation because let me only go and do that calculation. Right? I need to show what do I need to show? Investment in associate at 31st December 2007 or 8, I don't know. Okay. Okay. You all know if I need to show this, all the values must be in fair value. That's the first rule. All right. Rule one. All must be in fair value. Okay. So 10%, how much was the fair value of the 10% on the date of acquisition? How much was the fair value of 10% at the date of acquisition? On date of acquisition, which is 1st July, the 10% fair value, the 10% fair value is 26 million. Right? He itself has given us 26 million. Right? 26 million. How much is the 12% cost? How much is the 12% fair value? It is 23 million. Right? 23 million. Okay? 23 million. Okay. Am I missing something else? Okay. 10 million. Okay. Here it is. There's one last point. See, Geico is an associate, right? Associate makes a profit of 20 million. Okay. For the year end. Geico is an associate. Associate is making a profit. Now, I won't simply buy a company which is on a loss making, right? I'm buying a company so that I get a share of their profits. So, how much share am I going to get? Geico has made a 20 million profits, right? Geico made 20 million profits. I invested, how much? I invested 22%, right? Be careful. It's a mid-year acquisition. So profits I only need to take from the date of acquisition to the financial year. That means from 1st July to 31st December. So that is July, August, September, October, November, December. For 6 months, I need to take the profits. For 6 months. Most of us forget we don't take the 6 months. Right? Most of us forget we don't take the 6 months calculation. Right? We don't take the 6 months calculation. Okay. How much is my investment in associate? Why am I wrong? Oh, sorry. The 12% was bought at 30 million, right? Sorry. Okay. The 12 million was bought at 30 million. I'm really sorry. It was my mistake. Okay. Let us now compare with this one. Okay. We are correct. Okay. Okay. So say the examiner gives for your DSE, the examiner gives for this calculation about 3 marks. Okay. So we already have here 4. We already have here 4. We have another 3 here. That makes 7. Another 2 marks only. 2 marks, right? Whatever you all want. 2 marks, right? Whatever you all want. I will tell you what you all need to write. Right? You all can write about the share of net asset. This share of net asset you all need to be going and showing under your P&L. Right? Go and show under your P&L. Okay. Go and show under your P&L. You can go and show under your P&L. Okay. Here it is. I have mentioned that part here. I mentioned you can go and show it under your P&L. Right. Uh, to find out the gain or loss, I told you, right, when you all have a step up acquisition, you all need to find out a gain or loss. How do you all find the gain or loss? Fair value, right? Uh, Fair value versus carrying value. Difference is gain or loss from disposal of associate. Right? They have given us the fair value. They have given us the fair value. How much did they give? 26 million. But unfortunately, they have not given us the carrying value. So we can't find any gain or loss. So simply leave it. Simply leave those. Simply leave those. Right? All this you all need to write. Right? All this you all need to write. You all need to write. Okay. All this you all need to write. Post acquisition here 2.2 PNL you all need to mention 1 mark. The gain or loss 3 million for the 10. I told that 10%. FBOCI that one, and the dividend, right? And the dividend. Okay. You all mentioned all of this. You all will be able to get at least 8 marks maximum. I'm 100% sure 8 marks. Why not? You all can get 9 marks as well. So this is it in terms of what's the question? Greer Co, right? This is it in terms of Greer Co. Hopefully all have understood, right? Hopefully all have understood. I have gone about 1 hour 40 minutes. I'm really sorry. I'm always trying to reduce my level of explanation, but I feel that I need to give you all a perfect understanding. So that's what I'm always extending. But I will somehow try to make sure that my content is less as possible. So hopefully I'll understood. If you all have any further doubts, contact me on WhatsApp, right? On the group. If I don't respond to the group, try to do a private DM, right? Within 48 hours, I'll try to respond whenever I'm free. Okay. For the people who are watching the recordings on YouTube, right? For the people who are watching the recordings on YouTube, feel free to comment on the comment section. And if you all have any feedbacks in terms of my presentation, in terms of my vocabulary, in terms of if you all see that my explanation is too fast, or it has a lot of content, or if it's too which too much, it takes a lot of time, simply drop it on your comment section. I'll go and read through and we can rectify it. Okay. So if that is all, thanks a lot for joining. Right. I mean, no one's joined, to be honest. Right. I'm recording this. Can you see? I'm recording this so that once I record it, I'll be uploading it on my LMS or my Google Drive. All right. So you all can watch. So this is all I could do for you all. All right. Hopefully you all get the 100% of it. Okay. 100% benefit of this. Right. Anyway, good night. Stay safe and hope to see you all in another session. Right. Thanks a lot.